Hi, and welcome to my YouTube channel, Financial Experts. In another exciting episode of the banking concepts, we are here to understand the need for ratio analysis. This presentation explores the importance of ratio analysis in understanding and improving the company's financial health. Before we go in depth in this concept, let me give you a small introduction about myself. My name is C.A. Anjana. I am a chartered accountant, an author, speaker, ex banker, and I'm passionate about teaching. I have more than 15 plus years of experience working in banks, financial institutions, audit firms, and listed companies. I have authored the book From Mud to Amber, which talks about the struggles of a female banker and the ways adopted by her to establish her own business. My teachings have helped various working bankers in clarifying the banking concepts and have helped them in their day to day works. In my previous stint in one of the PSU banks, I was the credit head of a region and I have handled a book size of more than 3,000 plus crores of MSME in corporate business. With this background, let's deep dive into the concept of ratio analysis. First, let's understand why ratios. What is a ratio analysis and what is its importance? So, ratio analysis is a technique used to evaluate a company's financial performance and position by comparing different line items of its financial statements. Now, what does this definition mean? We will come back to the definition after understanding the meaning of it through some practical examples. For example, if there is a company A which has made a profit of rupees 10 and company B which has made a profit of rupees 5. Within this information, what do we infer? Which company has performed well? Obviously A, because A has achieved a higher profit. However, if I give you another scenario wherein company A has achieved 10 rupees and it has made a sales of 100 rupees. Company B, though it has achieved a profits of 5 rupees, it has made a sales of 25 rupees. Now tell me which company has performed well. Obviously, it would be company B because company B has made a profit margin of 20%. Now, how do we calculate the profit margin? Profit margin is nothing but whatever is a profit divided by whatever is your sales into 100. This is your profit margin. So when we compute this profit margin, we come to a conclusion that company B has incurred higher profit margin than company A. So in this case, company B has performed well. So what is ratio? Ratio will help us establish relationship between two numbers. In this case, it is helping us to establish relations between profit and sales. So it has helped us to establish relationship between this 5 and this 25. So what is it? It helps us, ratio helps us in establishing relationship between two numbers so that we can come to a conclusion and make a logical decision with the analysis. So we have come to a conclusion that company B has performed better than company A. How have we come to this conclusion? By establishing relationship between these two numbers, profit and sales. So this is what ratio does. Now, let's understand this better with some other examples. For example, this company X had a current assets of 60 rupees in 2023 and current assets of 100 rupees in 2024. Now, with this particular input, what do we infer? We can just infer that company X current assets have increased from 60 to 100. From 2023 to 2024, there has been an increase in current assets. This is what we can infer. However, if I give you some more inputs, say for example, the same company X In the year 2013, it had a current asset of 60 rupees and current liability of 30 rupees. And in the year 2014, it had a current asset of 100 rupees and current liability of 110 rupees. Then what do we infer? We infer that for every 1 rupee of current liability, you have 2 rupees of current asset. So the current ratio, which is nothing but current assets by current liabilities, is 2:1. What is the meaning of 2:1? For every 2 rupee of current asset, you have 1 rupee of current liability. So the liquidity position of this company is good. Now let's take the same example of company X in the next year, 2014, wherein the current asset is 100 rupees, but current liability is 110. So current liability is more than the current assets. In that case, the current ratio is 0.99:1, meaning that for every 1 rupee of current liability, the company has 99 paisa of current assets. So if we have a 1 rupee liability, company does not have adequate current assets to pay. So here, the liquidity position of this company is bad. So just to summarize, what is the ratio? Ratio, what does it do? It gives relationship between two numbers. So in this case, we had seen the relationship between two numbers 60 and 30. Two numbers, current assets and current liabilities. So it gives relationship between two numbers in a logical way, so that we can come to a conclusion with respect to the performance, the strengths and weaknesses of an enterprise. So when I relate relationship between current assets and current liabilities, I understand the liquidity position of the company. Similarly, when I relate to total debts to total tangible net worth, I understand how solvent the company is. Now, let's go into the definition of ratio analysis. So what is a ratio analysis? It is a technique which is used to evaluate the company's financial performance and position by comparing different line items on its financial statements. So what have we seen is what has been written in this definition. So what is it? It's a technique. One, it is a technique. What does the technique do? It will evaluate the company's financial performance and position. So it is a technique which evaluates the financial performance and the position. How does it evaluate the performance and position? By comparing different line items on its financial statements. So I hope you understand the definition of ratio analysis now. Now, what is the purpose of ratio analysis? It provides insights into the profitability, liquidity, solvency, efficiency, helping the investors, creditors, and managers take informed decisions. So the decisions it helps in decision making. Now, let's understand the importance of ratio analysis. It actually helps in measuring the performance, company's performance against the industry benchmark and its own historical trends. It helps in risk assessment because it reveals the potential financial risk, such as liquidity problems or excessive debt. Third is trend analysis. This ratios over time helps in identifying improvements or areas needing attention. And fourth is the investment decisions. This provides valuable information for investors to evaluate its potential investments. Now, what are the key financial ratios? Basically, there are four key financial ratios: liquidity ratio, profitability ratio, leverage ratio, and activity ratio. Liquidity ratio, it measures the company's ability to meet short-term obligations. Profitability ratio, it indicates how profitable a company is and its efficiency in generating profits. Leverage ratio, it shows the extent to which the company uses debt financing, and activity ratios will show how effectively a company manages its assets and liabilities. There will be a separate video which will, for each and every key financial ratio, in which we will in depth talk about them. So there are three kinds of liquidity ratio. One is a current ratio, quick ratio, and cash ratio. Now, current ratio, as I have already told, it is nothing but current assets by current liabilities. What is a quick ratio? See, when we reduce stocks from current assets, then it becomes a quick ratio. This quick ratio is a more conservative measure of analyzing the liquidity position of a business. And cash ratios are nothing but it just shows that what is the cash available in the business to pay the current liabilities. When we go to profitability ratios, we have 5 ratios, namely gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Regarding these ratios, I shall be posting a separate videos on the importance and calculation of these ratios. Next are your leverage ratios. Leverage ratio includes your debt equity ratio, debt to asset ratio, times interest earned ratio, and debt ratio. So, what are the key takeaways from this? Ratio analysis is a valuable tool for understanding the company's financial health and making informed decisions. By analyzing various ratios, stakeholders can gain insight into the profitability, liquidity, solvency, and efficiency, ultimately helping them to make sound investments or lending decisions. I hope you like the video. Thank you for your patient hearing. Please do like and subscribe to my YouTube channel. You can follow me on LinkedIn and you can purchase my book From Mud to Amber. The description, you can purchase the book, my book From Mud to Amber, available on Amazon by clicking the link given in the description box. Thank you for your patient hearing. Have a good day. Thank you.